Chainlink just secured partnerships with Swift, MasterCard, UBS, DTCC, Google Cloud, and AWS. 11,500 banks get on-chain access November 22nd when Swift SR 2025 activates. Meanwhile, Link trades 66% below its highs, and the Heikinashi RSI just printed its 11th consecutive red candle. That's one of the most oversold readings we've seen in 2 years. So either the market is pricing in catastrophic failure, or we're witnessing one of those rare moments where institutional fundamentals completely disconnect from retail price action. I'm leaning toward the latter, and in this breakdown, I'll show you exactly why $15 might be the most important accumulation zone of this cycle. Link is hovering around $15 right now, basically stuck in the same range I highlighted in my last video on October 31st. Back then, I established my load zone between $13 and $18. And guess what? We're still there. Price has been grinding lower, while institutional partnerships stack up like cordwood. The weekly chart shows us below the 10, 21, 55, and 100 EMAs, classic downtrend territory. But we're still holding above the 200-week simple moving average, that green line that's keeping Link alive since June. Market sentiment apathetic at best. Retail is completely checked out while institutions are building infrastructure. This timing mismatch is exactly what creates asymmetric opportunities, and the technical setup I'm about to show you explains why this disconnect cannot last much longer. Let's connect the dots on what's actually happening behind the scenes. First, Chainlink just launched the Runtime Environment, CRE for short. This isn't some minor upgrade. It's an all-in-one orchestration layer that lets institutions build institutional-grade smart contracts with privacy, compliance, and cross-chain capabilities baked in. The DTCC's managing director literally said, "By using partners like Chainlink, we're able to move very quickly and completely update financial markets." That's not crypto Twitter hype. That's the world's largest securities settlement organization going on record. Then you've got the Swift integration. 11,500 banks getting on-chain access when Swift SR 2025 activates on November 22nd. We're talking about the infrastructure that moves $5 trillion daily suddenly becoming blockchain compatible. MasterCard, UBS, Google Cloud, AWS, all building on Chainlink's rails. And here's where it gets even more interesting. Link is capturing 84% of the Oracle market share while generating 100x more revenue than competitors. Yet it's priced like a failed protocol. On top of that, over 63 million Link tokens withdrew from exchanges in the past month. That's a supply shock in real time. When tokens leave exchanges, they're either moving to cold storage for long-term holding or getting into staking providers, both bullish signals. Santiment data just ranked Chainlink third in Ethereum ecosystem developer activity over the past 30 days, behind only MetaMask and Radworks. Active development plus decreasing liquid supply, plus institutional partnerships, you're starting to see the fundamental picture here. Oh, and Chainlink Rewards Season 1 just went live. 9 build projects, Dolomite, Space and Time, XSwap, BrickCen, Folks Finance, Mine Network, Suku, Truff Network, and BitsCrunch are now distributing tokens to Link staking providers. This creates additional yield incentives for holding Link, further reducing selling pressure. Then there's the Injective EVM mainnet launch with Chainlink data streams integrated from day one, providing developers with reliable infrastructure for next-gen applications. Every single one of these developments points to the same conclusion. Traditional finance is building on Chainlink, not experimenting with it. Now let's talk levels, because fundamentals don't matter if the chart says sell. The weekly timeframe tells the story here. Link's been trading inside an ascending channel since August 2023, orange dashed lines on the chart. Support has been tested multiple times. September 2023, August 2024, April, June, and October 2025. Each time, buyers showed up. That's not random. That's structural demand at the channel bottom. Right now, we're testing the lower boundary again around $15, just above the volume profile point of control at 1430. That point of control is critical. It represents the price level with the most volume traded over the past 2 years. If price drops to 1430, that level acts like a magnet pulling in buyers. It's a confluence zone where the channel support meets the highest traded volume. If we get a bounce there, we would be making a higher low compared to the June 2025 bottom at $11, which would confirm the uptrend structure remains intact. But there's resistance to deal with. The descending trend line formed in August 2025 has rejected price twice, September and October. First meaningful resistance sits at $18, the 382 Fibonacci retracement level, measured from the December 2024 high of $30, down to the April-June 2025 low of $11. Breaking above that changes the entire technical picture. My strategy hasn't changed since the last video. I'm accumulating between $13 and $18. My stop loss is a weekly close below the ascending channel. If that happens, I would keep my long-term bag but exit short-term positions, then look to reaccumulate around $10 if we get there. My take-profit targets. First 30% at $23. That's the 618 Fibonacci level. Next 30% at $30, which was our previous high. Then 20% at $45, and final 20% at $63 where the 2618 extension sits. Timeline for those targets? Up through August 2026. Now here's what makes this setup compelling. The Heikinashi RSI is at levels we've only seen 3 times in the past 2 years. Both previous times, when RSI hit extreme oversold with many consecutive red candles, price reversed violently to the upside. I've marked those instances with white circles on the chart so you can see the pattern. We're entering that same zone right now, but this time with fundamentals that are objectively stronger than they were in 2023 or 2024. Here's how I'm thinking about this. My best case scenario. Swift integration catalyzes institutional FOMO. We break the descending trend line and $18 resistance, and Link runs to $23 or $30 by Q2 2026. That's a 50 to 100% move from current levels. The worst case. Broader market weakness or unexpected competition breaks us below the channel, and we retest $10. That's a 30% downside. The risk-reward ratio favors accumulation here, especially given the supply dynamics and institutional adoption trajectory. Short-term, I'm watching that 14 level like a hawk. Long-term, nothing changes my thesis unless we lose the ascending channel structure and stays below $10 for more than 2 weeks. Timeline matters. This is not a quick flip. I'm positioned for moves that play out over the next 6 to 12 months. Here's the bottom line. Link at $15 with 11,500 banks coming on-chain and extreme oversold technicals presents a setup I cannot ignore. Markets eventually correct these fundamental technical disconnects. The question is not if, but when. If you found this analysis valuable, hit that like button. Genuinely helps the algorithm show this to others who need to see it. Join my free Telegram group for faster daily crypto updates. Link is in the pinned comment. I recently covered Uniswap's fee switch potential and Sonic's network performance. Check those breakdowns if you want more setups with similar risk-reward profiles. Stay patient, stay strategic, never financial advice, and I'll see you in the next one.